Okay, now this one, is it working? Remove. Okay, save changes. Is it working? Okay, and I have a link to the stream, so copied. And I apologize for this being so long. Okay, give me one moment. All right, now I'm just looking to see if this is actually working. There is a chat. Does work. Okay. Okay, so Miroslav joined. So the chat is not coming over to StreamYard. That's interesting. So the chat is only in Substack. Okay, so can you guys hear me? Is it all lagged out? I'm trying a new software platform that failed to have the audio work successfully for my weekend video. So I'm making this to hopefully satisfy you guys who didn't get my weekend video. Yep. Okay, and it's not lagging out or anything like last time. Let's see. Working good. All right. Thank you very much. I think there's a little bit of a delay here. One thing that I really wanted to show, aside from, we'll obviously talk about the Iran war situation, but one thing that is really bizarre right now is a divergence between the private ADP data, which has 63,000 jobs created. And more importantly than that is the bulk of those jobs are in small enterprise. And that's the sign of a super healthy economy. Last year, before Liberation Day, small business optimism was high, and that would have implied a lot of small business hiring. So this is a sign that the labor market is healing. Then you go to the BLS data, and the BLS data has 92,000 jobs lost for the same time period. And the BLS data has been terrible. I remember Trump fired the head of the BLS, and everybody said, "Oh no, it's Pravda. He's firing his political opponents." No, the data is bad, and they still haven't fixed it yet. I think the signal is this private payrolls ADP data, and I think that's what's really happening with the labor market. And I think people that are paying attention see that, look at what's going on with ZipRecruiter. Green on the day, breaking out above the 50-day moving average. Just a fantastic looking chart. And this rally started with that private ADP data, and it did not sell off with the BLS data. So on my summary for what I'm buying last week, I had put ZipRecruiter on there. I think this is the turnaround in the labor market. I think this is the first green shoots that you can see. So this is about as early as anybody could possibly be on top of this, would be that very strong ADP payrolls on small business hiring. And the market taking that to mean that ZipRecruiter is back. And they had, in their last earnings call, they had positive year-over-year revenue growth. But in their own surveys, they had said, hiring optimism is good. They're going to be coming back, and nobody believed them. And they got this awful software sell-off from $5.50 down to $1.75. So how much of the Zip rally is in sympathy with the software bounce? Matt Miller is asking. Some of it is going to be, but I don't think the software bounce, if I go to IGV, I don't think the software bounce is, for one, it's not as extreme. For two, it's not as broad. I think the software bounce, people are going to have to pick through winners and losers. And that's going to be a very hard amount of work. But I like what the CEO of Neptune said, which is that proprietary data is the moat and models are going to become a commodity. And ZipRecruiter has a lot of proprietary data. They've been one of the leading job platforms for years. So they have a lot of proprietary data. And I think that they might fit that answer for being one of the winners. So I don't think this is purely, I don't think it's pure, and also they're kind of small. I don't think they're a huge component of ETFs. So if people are just buying ETFs, if I just look up a IGV ETF component, I don't know if ZipRecruiter is even in there. The fastest thing might be to just ask AI if it's in there. But if I go to holdings and filter by keyword ZipRecruiter, yeah, so ZipRecruiter isn't even a component of the IGV. Z, Zeta, Ring. So yeah, those are all the companies with a Z in the name. So I do not believe that ZipRecruiter's bounce is with software generally. I mean, it could be. So the hedge funds will have their factor work, and they will do things by factors, not by ETFs. But again, this bounce is larger than the IGV. It's green on a day when the IGV is red. I think this has to do with this big divergence. This is, aside from the Ukraine war, one of the things that I really wanted to sound the alarm on and ring the bell on was this divergence between the ADP payroll data, which is super bullish. I mean, you lose, let's see, super bullish because one, it's, job growth. There's a lot of seasonal adjustments that have to come after Christmas. You lose like 1 million jobs from temporary, I think it's 3 million jobs from temporary Christmas workers. So people are hiring in the spring. The mainstream financial media still seems like we're heading into recession or the consumer is weak. But adding a significant chunk of jobs in small businesses, that's what a super healthy economy does. So I'm extremely bullish about this. And this divergence between the BLS data, I think you just have to go with, now the Bloomberg talking head, all the CNBC people are using the BLS data. And I think that's a mistake. I think the BLS data is garbage. It's garbage in, garbage out. They haven't fixed their models yet. And last time that there was a BLS data point that made Trump look good, I saw people were saying, oh, it's because he put his person in there. And the former head of BLS who had been fired on Twitter said, no, the people that still work at the BLS are good. The systems are in place. Things haven't changed yet. So I would take the former head of the BLS's word for it that this information is based on old systems. I would discount BLS data and I would look at the ADP data. That's my best take on the situation. And then, back to, let me see. If I look at, give me just a moment to pull up I had done this for an hour and the audio didn't record like an absolute idiot. So one of the surprising things going on in commodity land is we have, so crude oil up to 94. So crude oil is up 48% on the month, 33% on the week. But the oil and gas explorers and producers from the start of the Iran war jumped up from 107 to 114. The explorers and producers are not up 33%. Now, energy had this huge rally from the start of January into the end of February. And the question is, was this pricing in the Iran war, or was this pricing in that heavy asset low obsolescence trade? And I think that this is entirely heavy assets low obsolescence. And the Iran war itself, there was a couple weeks where you could see ships moving to the Persian Gulf, but that period it was relatively flat. I mean, February was a choppy month. So the oil and gas explorers and producers did not trade up on ships moving to the Persian Gulf. So I think the rally here from the Iran war is small and much smaller than the oil price. What that means is the market, which could be wrong, but the wisdom of the market is that this spike is temporary. So Miroslav is asking, can streams be saved? Yes, this one will be saved. Last one, it was so laggy that I couldn't post it. It was just torture to watch when I was proofreading it. So I will save this. I will post it, sort of a replacing my failed what am I buying this week. So anyway, I think this spike is all that the marketplace is giving energy producers based on the Iran war, which is a prediction that things are going to be over soon. Sam is asking, how would I compare the employment data with the market on the consumer, i.e. clothing, restaurants? So the market is really negative on the consumer. And this is what I put as one of my top buys for the what am I buying this week. So American Eagle Outfitters, I mean, the market just thinks that the consumer is dead. And what's interesting about that is, so for apparel, the cost of Ozempic, the GLP-1 producers brought the cost of Ozempic down from $1,000 a month to about $150 a month in order to compete with all the off-brand bootleggers. And that means that the target Ozempic user, which is a millennial woman, like a professional office working woman, she now has $850 a month discretionary income. She didn't before. She was paying $1,000 a month. Now she's paying $150 a month. What is she going to spend that money on? And I think the answer is clothes, because she's not going out to eat, right? She's not going to spend it on food. And also desire for alcohol is down on GLP-1. She's not going out drinking. So the number one thing they spend money on is clothes. And right now, blue jeans have replaced yoga pants. So I'm super bullish on American Eagle here. They just had a good earnings. They are buying back stock. I think the sell-off is bizarre for the Iran war to hit blue jeans. And they announced really good earnings at this time. So this move is really shocking to me. It's right here on the 200-day moving average. This is one of my strong buy recommendations for this week. Now, restaurants are different. I think restaurants are going to take some time to come back, but I do think Dine Brands, right? This sell-off is overdone. Wow, it's down another 5, 6, 7% today, intraday. I think the sell-off is overdone in Dine Brands because this was happening even since beginning of January. So I think this is probably getting close to time. You saw the RSI go from overbought to oversold. Let's see. Daymu is asking, can I share my near-term and long-term thoughts on Abacus Life and Cogent Communications? So Abacus Life is my absolute favorite company in the world right now. I really like what they're doing. The ability to sit on to be sort of the market maker, to sit in the center of an ecosystem for a $13 trillion asset class and to have very little viable competition. I think this company in the next 5 years, the growth is going to shock you. I think Jay Jackson has been on this sort of acquisition growth strategy for 2 years. And there's that saying, people overestimate what they can do in 2 years and underestimate what they can do in 5 years. I think that's a Steve Jobs quote. It could be, or even might be Bill Gates. I think over the next 3 years, by the time you get to 5 years out from Jay Jackson's push to transform the company, you're going to be shocked at what it does. So this is the largest position that I have right now that I bought up to that size. It's not my largest position because Babcock and Wilcox has gone crazy. And I sold out of my applied opto. And then regarding Cogent Communications, CCOI, now, which has just been getting terribly punished. So Cogent Communications, the short term is they're going to sell 24 data centers and raise something like $500 million. And that's, they're about to raise in cash half of their market cap. That should fix the share price. And the share price should be back to something reasonable in the next 6 months when they do that. Longer term, and I'm thinking about 5 years here. So what people are discovering with AI, now that AI is 3 years old, is the amount of stuff that AI is going to do. I have to imagine that traffic across the internet is going to increase dramatically. And it's going to be over time, and maybe it's a 10-year story, but Cogent Communications owns the pipeline for 25% of internet traffic. So this is critical infrastructure, and we're going to see what AI will do for increasing that traffic. But I mean, some of it is people didn't even used to really save all that much data, because why would you pay for the storage? But now that AI is going to use that data and data is valuable, the amount of data that people save is going to increase, and the amount of AI agents that are querying that data to analyze it and transfer it is going to be, dramatic as well. So you have 25% of the internet's infrastructure in the middle of the AI revolution, I think Cogent is going to work at some point. You know, I don't think we're going to get 5 years from now and it's going to be a $40 stock. I think 5 years from now it'll be probably a $120 stock. So can you wait 5 years for a 5x? I think that's that's definitely above market returns, but it's going to be based on the massive volume increase in traffic from AI, which we're just, I mean, white collar workers, some of them are having 10 different unique AI agents doing different tasks at all times. It's just a dramatic amount of usage. And the limiting factor right now is it's really expensive to use. So the cost has to come down with the data center build out. But I mean, they're data centers. The data has to go through the fiber optic cables. And my best understanding of physics is that Starlink will never compete effectively with laid fiber, because laid fiber goes in a straight line, and Starlink, so they're both the speed of light, right? But Starlink, you have to go up into outer space and back, and you have packet loss from the weather. So the laid fiber has no packet loss, and it's the speed of light in a straight line. So my best understanding of physics is this technology, this laid fiber, will never go obsolete in the same way some other technologies do, because you're already pushing the speed of light. Which is kind of fantastic about it. So again, you've got 25% of internet infrastructure. Oh, and another thing is they don't have to compete to get hooked up to data centers, because the data centers that want 99.999% uninterrupted uptime, they don't just have one internet service. They have all of them. They have 4 or 5 internet services, because if one of them goes down, they have the other 4. Because if you build a $2 billion data center, you know, are you not going to pay your $100,000 a year internet bill? No, you're going to have 5 internet bills, because you don't want any downtime. So they're going to get hooked up to all data centers over time. And they just have to grow into that acquisition. So I'm very bullish in the long term. In the short term, you know, who knows? You know, day to day, I don't know, but 5 years, this is a great thing. Sloth bowl apocalypse is real. Yeah. So the sloth bowl, part of the problem is, so when you say slot bowl, you're talking about Chipotle, Sweet Greens, Kavas. Some restaurants focused on the Sun Belt where there was population growth, but the slot bowl restaurants focused on Washington, D.C., where there were lots of white collar workers. And the white collar workers, not only did Trump fire 300,000 federal government employees, but there was over 1 million federal government contractors. And we don't even know how many of those have been fired. My wife's cousin is one of those. And the whole D.C. ecosystem is struggling right now. So Sweet Greens and Kava specifically targeted Washington, D.C. for their expansion plans, and they got decimated. So yes, the slot bowl apocalypse is real, but Applebee's is doing fine. They've got positive year-over-year comps. If Portillo's had had a chief marketing officer the whole time, I'm sure they would have positive year-over-year comps as well. So restaurants are going to be tough. I think the interest rate sensitive sectors, what I really want to be in right now is mortgage origination and interest rate sensitive industrials. Like I have a hard time seeing Alta Equipment Group not working well here. So, I mean, I've got a $35 price target on this stock, because they just have to be pulling in their $200 million of EBITDA a year and trade up to a price to sales of 0.6 to 0.8, and that makes it a $35 stock. And with this getting back into normal times, I mean, and I've showed you guys this graph before, but just it's so shocking how much, excuse me. So this is the ISM manufacturing survey. So this is, so yeah, you had ISM manufacturing. Let me go to 150. It was below 50 from September of 2022 until January of 2026. You've got a over 3-year manufacturing recession. This is brutal. I mean, a 3.5-year manufacturing recession. So all of these little industrial companies, people are like, oh, I looked at the data for the last 3 years and this company is trash. But we haven't had normal times at any point in the last, we've had a 3-year recession for manufacturing. So I think these little industrials are going to surprise everyone with their earnings power dramatically. And then, am I sure the market isn't sniffing out a weak consumer right now? All the non-food consumer discretionary companies I pay attention to, Crocs, Newell, Lulu, have had a rough week or two. So Eric Peden is asking about the consumers. The stock prices are down on consumer discretionary, absolutely, but and also all the consumer companies, they all forecasted for a weak year. And I talked to the so I was able to speak with the chief financial officer of Tile Shop. I didn't write that in the write-up, but I had a pretty good call with the chief financial officer of Tile Shop. We just went through the game theory. All these consumer discretionary companies, they thought it was a rebound to growth in 2025. They broadcasted a return to growth in 2025, and liberation tariffs made them wrong. So none of them broadcasted a return to growth in 2026. None of them did. And I asked them, like, but you can see the tax returns coming. You can see the consumer, wages are rising. Why would you not broadcast a return to growth? And the answer is, it's just game theory. There's no benefit. Like, if you broadcast a return to growth, you could be wrong. And if you don't broadcast a return to growth, you can say, oh, well, we surprised to the upside. So there's zero reason for them to broadcast a return to growth, but all of the macro signals say 2026 should be a good year. So every single consumer company has broadcasted a flat year, and most of them are going to have a growth year. And so I think the market's not, the market's pricing in with their forward guidance is flat, and I think you're going to see they're going to grow. It might be a second half of 2026 story, but I think they're going to have a good year for them. Thomas says, is there a bankruptcy risk for Alta Equipment Group? I don't believe there is. So if you look at the debt for Alta Equipment Group, it looks terrifying. But again, you have to break down the floor plan financing from their actual debt. Their actual debt is pretty small. So again, yeah, they've got 1.1 billion of liabilities or debt on their enterprise value. But if you know about their floor plan financing and you go to their inventories, most of their inventory is on floor plan financing. So if I go to balance sheet quarterly, so their inventory, so let's see, their debt, short-term debt, total current liabilities, long-term debt. If I break down how many of this is actually bonds versus floor plan financing, I don't think they actually have a huge amount of debt. Let me see if, oh yeah, thank you for telling me that the audio is good, Chris. I switched from OBS Studio to StreamYard because I wanted to have better audio. Let me see if I can just real quickly, liabilities for Alta Equipment Group. How much debt versus how much floor plan financing, coupon and maturities. Okay, let me try and break down the floor plan financing versus the actual debt. And so Alta Equipment Group did take on debt in order to finance their acquisitions, but they were doing it at something like 4 times EBITDA. I mean, their acquisitions were very cheap. They do have some debt, and the interest rate is relatively high, but I think they'll refinance it relatively soon. Let's see, senior notes about $500 million. Let's see. Anyway, yeah, that's AI is thinking about that, separating that. Anyway, when you look at the balance sheet of Alta Equipment Group, you just have to separate the floor plan financing from the actual debt and know that in a return to normal times, they're going to be fine. I don't think there's a bankruptcy risk. I did send out an email to try and get another video chat with the CEO, because they met with me once for Alta Equipment Group, and I want to say hello to them again. I timed it wrong because I hit them during the blackout period. So we'll see if I can get an appointment with them. What else was I going to talk about? Okay. Yeah. So I think one of the big winners of this whole Iran period is going to be Brazil. And Brazil sold off. I mean, this is bizarre. Brazil sold off with the Iran war. Part of this is degrossing. People are selling everything. Oh, and speaking of degrossing, Interactive Brokers increased margin requirements for everybody. So, and that's, you'll see that with gold prices. So gold is down. People are asking, well, why is gold down? Isn't gold a safe haven? And the answer is, gold is down 0.2% today. When people have to sell, people are on record amounts of margin and they have to sell, they're going to sell everything. So as people sell everything, everything is down, including gold and including Brazil. But I think Brazil, the baby's really thrown out with the bathwater. Colombia, the baby's thrown out with the bathwater. But Ecopetrol has been bouncing back hard these last couple of days. PagSeguro is my favorite Brazil stock. And that's trading at a really nice discount. I think this is a really good price for PagSeguro. So as far as what am I buying right now, I like PagSeguro. I really like, ZipRecruiter. Yeah, those are places where I'm looking at. Let's see. And then what is the answer? So for Alta Equipment Group, let's see. So that 100 million of the debt is operating leases. That's just paying your rent. Long-term debt. So they've got about 500 million of long-term debt, and I think that's at 9%. So that's something that they could refinance as interest rates come down. And I think they will. I don't know the maturity there. They've got 300 million in floor plan financing, which leaves them 750 million. So they've got a 500 million note at a 9% coupon and about 210 million on a variable rate, which is about 6 to 8%. So yeah, they did about, they did a huge amount of acquisition, huge amount of roll-ups. But they're, if you take 735 million of a real debt, not including the floor plan financing, and you compare that to 200 million of EBITDA, it's about 3.5 times net debt to EBITDA. That's not a terribly over-levered company. It's very reasonable. And then the floor plan financing, the way that works is companies forward the inventory to you, and depending on the industry. So, for example, dirt bikes, things like that, they get like 6 weeks of interest-free inventory holding. But these Alta Equipment Group, the default in their industry is 6 months. And the Japanese brand that wants to take market share is giving them 1 year free floor plan financing. So the equipment can sit a year in their inventory before they have to pay interest on it. And once you get normal market conditions, once the inventory starts moving, it's much more likely they're not paying any interest on their floor plan financing. So this company, when they get to normal times, the amount they pay in interest is less because their inventory is moving faster. And then plus their inventory is moving faster. So they get huge operating leverage, huge interest rate sensitivity. But yeah, they're probably going to focus on paying down debt for a couple of years at least. And that might make some acquisitions off the table, but I think they're in a really good spot, and I think their earnings are going to surprise. What else that I looked at? American Eagle, I looked at. Oh yeah, the mortgage originators. Rocket got absolutely destroyed, and I'm not entirely sure why. It's up a little bit today. I mean, this company got pushed. The sell-off that started in January. This was quite a. Now I had said that this was going to be a magic money machine, that this is going to have huge volatility. I thought it would stop at 17. I didn't think it would get to 15. This is actually I think a buying opportunity now. If I go to my charts, this is so yeah, the mortgage purchase applications index. Except for 1 week, every week in 2026 has had more mortgage applications than 2025. I thought it would be a little bit higher than this. The first few weeks of January, it was significantly higher, and then February was a bit dead. But we're heading into the spring. The spring and the summer should be very strong. I'm going to look forward to this being significantly higher. For one thing, there's now competition. So if you look at the mortgage spread, the spread between the 30-year mortgage and the 10-year treasury, that's historically been about 1.5%. But under Jerome Powell, who was rolling off mortgage-backed securities from the Federal Reserve balance sheet, it was 2.5%. When Trump told Fannie Mae and Freddie Mac to buy $200 billion of mortgage-backed securities, about 0.5% came out of mortgage spread. So 30-year mortgages are 0.5 percentage point cheaper. There's another 80 basis points in a typical mortgage from markup, from costs. Both Beeline, Open Door, and I think Better Homes are doing AI mortgage origination, which means their costs, mortgage origination had something like $12,000 of labor costs and $12,000 of gross profit. My point of all this is saying another 0.5% of the 30-year mortgage can come out from margin compression from AI mortgage origination. So I think even if the 10-year treasury stays at 4%, you could have a 5% 30-year mortgage from compressed margins and from Fannie and Freddie buying mortgage-backed securities. And a 5% 30-year mortgage is going to just explode the housing market all over the place. But Rocket in particular, so when Rocket bought Cooper, they bought a huge portfolio of servicing mortgages. And we're up to the point where more than 20% of mortgages have a 6% rate. So if they can offer people 5% refinancing, they're going to be marketing the hell out of this to their book of mortgages that they're servicing. And I think they're going to originate a lot of refinancing more aggressively. We haven't had a fintech environment yet where the fintech companies were aggressively marketing to their own portfolio of serviced mortgages, saying, hey, how would you like us to lower the bill? And again, they can get that mortgage origination cost down. And it's Rocket's just gonna slam that button. And so Rocket stands to benefit disproportionately from the refinancing. And then one thing that I thought was really interesting, this isn't bullish for the housing market. So here's where Jerome Powell raised interest rates in 2022, and prices, so home prices were high because of COVID, and then interest rates were high when Jerome Powell rose interest rates, and this was a record housing unaffordability, similar to the 1980s. And wages have been rising, interest rates have been coming down, but artificial intelligence uncertainty. So now there's a new cause of people not buying homes because they don't know if their job is secure. So as prices have been flat, but wages have been rising. So house prices being a reason they can't buy the house have been coming down. And then interest rates are coming down, but then people's job security is worsening. So this is a negative. Thomas is asking, can mortgage rates go to 5 if inflation comes back? I am not anticipating a return of inflation. I'm anticipating, 2 years ago, my portfolio was about sustained inflation. And since that time, if you look at the numbers as what percentage of the economy is services and what extent AI is going to cause disinflation in services, I think that we can have simultaneously a commodity super cycle in hard commodities and metals. You can have costs of inputs of physical things going up, but the costs falling so precipitously in services that you might have an overall CPI that actually is not putting pressure on mortgage rates. If inflation comes back, no, it's just the AI wave is so powerful, it's hard for me to see inflation coming back. But if inflation came back, that would throw a monkey wrench into this. One problem would be, so we're going to get a new Fed chair in May, and the new Fed chair is beholden to Trump, and the new Fed chair is looking at this labor market, and the BLS says the labor market's awful. So, even if we did have inflation come back, is the Federal Reserve going to prioritize labor versus inflation? And I think they would prioritize the labor market over inflation. So, I think, the new Fed chair is probably going to cut the overnight rate. But even then, that might not move the 10-year treasury so much. But as the overnight rate falls, the amount of interest the Federal Reserve pays on its debt falls, or the amount of interest the U.S. Treasury pays on its debt falls. And then as that falls, the deficit shrinks. And as the deficit shrinks, the fiscal situation for the US government is more stable. So the 10-year treasury could fall on that alone. So yeah, could inflation spike? So I'm actually predicting both things. I'm predicting rising costs of hard commodities from the commodity super cycle, but falling costs of services so fast from artificial intelligence that the overall inflation numbers are actually going to be very low inflation. And what this means is the next Federal Reserve rate hiking cycle could be so many years away, it would surprise us all. All right, so back to mortgage. So Rocket is extremely cheap here for Rocket. I built out my full position in Beeline. This one, and this one behaved very well. This had almost no give back from the Iran war. This chart is very encouraging. It went from overbought, it consolidated, it never got to oversold, but it's gone through this consolidation period and it stayed above the 50-day moving average. And now it's compressed onto the 50-day. The next leg higher could be here. So selling pressure on the MACD has disappeared. The RSI never got to oversold, but it's turning up. And then also their next earnings is coming up. Beeline's next earnings call. When is their next earnings call? Did they announce Beeline? Did they announce their next earnings call? It should be coming up very soon. Where is Beeline's next earnings call? Anyway, and remember in October, they predicted a 65% quarter-over-quarter revenue growth. 65% quarter-over-quarter revenue growth is insane. So this is a company that I built my full position on. It had a huge spike the day that I wrote about it. It's actually kind of moved the market a little bit. As tiny little 79 million market cap company. I think this thing gets to $1 billion before somebody buys them. This is going to be, I think, fantastic for this mortgage origination cycle. And then Open Door, my position's been full since July. So I haven't been buying. I've been selling puts every week. This thing is compressing to get to some point. You know, this bull flag has been consolidating and compressing. You know, February choppiness, it was below the 200-day for a bit, but it's resting right here on the 200-day. It's approaching the 50-day. This is going to get to a make or break moment, and it'll probably get to a make or break moment before the next earnings call, because the earnings call was very recent, and the technicals, it's either going to break up or break down pretty hard. And let me go to their, they made these trackers to see how they're doing. For one thing, their October cohort already had the gross margins that, click on accountable and investor relations resources. The October cohort already had the gross margins that I thought that they would have after mortgages were implemented. So they were already getting gross margins of, net margins of, 10%, 10% net margins, or 10% gross margins anyway. This is their tracker for how many houses that they're acquiring. And they've been above trend line for a good bit. So they've been growing since, this is the beginning of the new management team, was in late September. So they used to have the graph used to go further to the left, but they put Kaz's picture there. And the trend for house acquisitions is up. Volume is going up. Now their guidance here is flat, and they were guiding toward not growing aggressively while they were still building out their systems. They were guiding to growing aggressively into the fall. But what's been happening is they get all this free advertising by being a meme stock. And as they get free advertising by being a meme stock, people want to sell their home on Open Door just to try it out. So their volumes have been increasing even before they start slamming the advertising button. So again, we're still in a period for 6 months where they want to build out systems and perfect their systems, and then have their planned rapid volume increase. But they're already way above trend line from free advertising. So Yeah, open door, but technically it's compressing to break up or break down. And I think it'll break up because you can see the volumes of acquisitions. And then I wrote up in my earnings update for them that October cohort having 10% gross margins is just really, really powerful. So if I had to buy anything right now, although all my positions are pretty much full everywhere, I would want to buy mortgage originators. But then I really like this dip on American Eagle Outfitters, and I really like this dip on rocket companies. Those are some great dips to buy. Oh, I wanted to tell everyone I have sold calls on 20% of my Babcock and Wilcox position. So Babcock and Wilcox got too large for my portfolio. It became a larger than 10% position, which was more than the weight that I wanted for it. It's time to trim, and I'm not good at trimming. So I sold calls on 20% of my position. I did April at a $15 strike price. I took cash off the table. So I think I'll get something, I think I got like $1.80 per call. So it's per share. So if it does get triggered and I sell, I get to sell my 20% of my Babcock and Wilcox position at $16.80, which I am thrilled because my cost basis is like $1.40. So this is just a fantastic victory, and the position is too large. And I'm happy to let 20% go here because I could use the cash to redeploy other places. And if the calls don't get triggered, so if it's not over $15 on April, was it 17th, then I just keep a bunch of free money, and that's good too. But I'm strategically exiting 20% of my Babcock and Wilcox. Now, that I think is a smart exit. I did not have a smart exit for Applied Opto. I sold the whole position on this huge candle day. I didn't get the best price of the day. And the thing is, it keeps going. So I don't have any more direct data center build out beneficiaries. And I wanted direct data center build out beneficiary, but there is a lot of, this is getting to the point where it's expensive and risky, and I want to find something better. Because again, we got into this at, if you did it when I wrote up about it first last year, we got in around 12. So from 12 to 75, I consider that to be a victory. Now, by dumb luck, I managed to meet someone at a party who works at Google in their data center build out office. And of course, I spent the whole night not socializing with everybody and just hitting him with just too many questions. And I had seen a Twitter post alluding to this, which is if you look at all of the hyperscalers, the people that are in charge of the data center build out, they all have renewable energy backgrounds. None of them are petroleum engineers. None of them are natural gas engineers. They have 0 people in the data center build out at the hyperscalers of people that are experienced in hydrocarbons. And I got in kind of the inside scoop on Google's plan to build 40 data centers over the next 3 years. And the default system is solar with grid scale lithium backup batteries from Tesla. Tesla makes the best grid scale lithium ion backup batteries with some tiny bit of natural gas for load balancing, but not like a full backup of natural gas. And then the alternative backup is to be attached to the grid. And now I don't think that's very smart from Google's perspective, because you're talking about having $140 per megawatt hour when a natural gas plant could give you $40 per megawatt hour. So they're going to pay 3.5 times as much to have less reliable electricity, but it's their money and they can do it. So I might think about buying a silver miner to have exposure to silver if we're really going to build that many stupid solar panels in Texas. Texas Pacific Land and Land Bridge. So most of these are going to be in Texas because you can get permits and nobody lives out in the desert. So Land Bridge, I mean, Google's going to make 40 data centers in 3 years with solar panels in the Texas desert. So Texas Pacific Land and Land Bridge are probably good buys here. They just seem expensive to me. And then for the lithium, I still have Sibanye-Stillwater. Sibanye-Stillwater, I think, is a buy here. So Sibanye-Stillwater is back down and it's bouncing today. So I guess it had gotten officially too cheap and it's starting to bounce again. I think this is a buying opportunity for Sibanye-Stillwater. And especially back to the Google data center thing, they have Europe's largest lithium mine in Norway. So that gives lithium exposure as well. So if I add a silver miner now, Magna Mining has some silver exposure. It's mostly copper and nickel, but it has some silver exposure. Probably not enough. But I think all the miners are getting to be buys here. They've all sold off on fears of sulfur not being able to pass through the Strait of Hormuz. Have you guys seen how the Strait of Hormuz, because the US bombed all of the radar, Iran doesn't have a way of tracking ships. So this is a live, or not live, this is 24 hours the Strait of Hormuz. And what you can see is, so these ships, they turn off their transponders, right? They go dark, right? And then they go around the Strait of Hormuz and they turn their transponders back on. So you can see them here. They'll disappear and then they'll reappear. Now, this is not 90 tankers a day like normally passes, but the Strait of Hormuz is not shut down. And I think that's what people had discovered on Monday and why oil went from $105 a barrel back down to 95, is that the Strait of Hormuz is not shut down. So again, you can watch all these ships. They turn off their transponders, they disappear, and then they reappear on the other side. So you can see them here disappearing and then reappearing. So the Strait of Hormuz is not blocked. Anyway, I thought that was pretty wild. Let's see. And then back to, so again, the fears that the sulfuric acid is not going to be around for miners, I think that's overblown. So I think miners that use sulfuric acid, those are all going to be, these are all dips to buy. Taseko Mines, Hudbay Minerals, I'm mostly out of. I only have a small position because I pivoted all to Taseko Mines. And then the one that's cheap that I'm still accumulating is Magna Mining. Because Taseko Mines got expensive for me. Bharat Modi says, did it stop? Is it paused? Is it still working for you guys? Can you still see it? Or is Bharat Modi the only one who it stopped for? Anyway, somebody says, check out RFIL for a data center beneficiary. I will add that to my, give me a moment. I'm going to add that to my research list. RFIL for a data center beneficiary. Okay. So yeah, data center beneficiaries, if Google's next 40 data centers are going to be solar panels in Texas, maybe I should buy more land bridge, although it's not as cheap as I thought it was. I did buy some at this 45. I brought it to everyone's attention at 45. This was a really good dip to buy. And now it's back up to 75. This isn't exactly where I want to buy it. Ramaco Resources got absolutely smashed. This is back even below where I had made this trade alert when it was about 15 bucks. It went up to 28. Now it sold off hard. This is positive on the day. So it's rebounding some. It's below the 200-day moving average. It's below the 50-day moving average. It's not quite a hammer candle. I think this is probably a buying opportunity. So for Elon Musk's, I think you need to take Elon Musk at face value that he's going to make data centers in space happen. And I did a search to try and figure out which metals are going to be needed for data centers in space. And it was gallium and germanium were at the top of the list. And those are two of the critical minerals that Ramaco Resources has at their Brook deposit. And then the third one they have in large volumes is scandium. And scandium, there's a good odds that they can get a purchase order from Boeing, because Boeing can make all of their airplanes 25% lighter by buying pretty much all of Ramaco Resources' annual scandium production. So I think this is a really good for critical minerals. I don't know when their coking coal, their metallurgical coal, is going to rebound, but I like Ramaco Resources here. What I've been buying more of, and only because they have weekly options, is Energy Fuels, because that's critical minerals plus or rare earths plus uranium. And uranium is probably positioned to break out. It's been 18 months since Microsoft paid to restart 3 Mile Island, and we haven't had any new build nuclear announcements. I think we're going to get new build nuclear announcements this year at some point. I mean, I think nuclear is a coiled spring. This is expensive for their cash flows. You know, this is expensive for their revenues. But selling weekly puts and taking that money, rolling it into buying a few shares at a time, I'm slowly building my Energy Fuels position. Julie's asking, am I recording and will I post this session? Yes, I will post this session. The last live stream, I didn't post it because the connection was bad. It kept jumping and skipping. It was too painful to watch. This one I will I will post this one for paying subscribers. And again, my apologies that the audio messed up for my weekly thing. Speaking of my weekly thing, let me see what I wrote there and see if there's any charts I want to look at for what I'm buying this week. So I mentioned Abacus, ZipRecruiter, American Eagle and Rocket, Babcock and Wilcox. Oh, so I didn't bring Riley up on Babcock. So one of the reasons why I'm happy to sell calls on 20% of my Babcock and Wilcox position is my thesis that it's all megawatts you can possibly get. Well, meeting a guy at Google who's actually working at the data center build out and finding out they're doing solar panels for the whole thing, my every megawatt hour you can get thesis, might not be true. I still think Babcock and Wilcox has 5 good years to land new contracts before nuclear starts getting implemented, at least. But it's too big of a position for my portfolio. But Riley owns 25% of Babcock and Wilcox, and Riley owns about $350 million of Babcock and Wilcox, and they're a $220 million market cap company. I think this is extremely mispriced, and they should benefit in a huge way from the M&A and the IPO wave. So I added a little Riley today as well. Talked about Brazil, PagSeguro, Sibanye, Stillwater. Yeah, so I've looked at all the charts that were on my what I'm buying this week video where the audio failed, because I've switched from OBS Studio to StreamYard, so hopefully the audio is better. And then what else to look at? So little industrials like Alta Equipment Group. I like Titan International. They sold off hard on the Iran war, and they're below the 200-day moving average. It's still negative for the day, but that is a very, very tall hammer candle. They should bounce back. What else? How long have we been streaming? Give me just a moment. It's almost an hour now, 53 minutes. What else was I going to look at? So, Acacia Research Group. I added a little bit of that today. They have natural gas exposure and intellectual property exposure. Those should be 2 bull markets, and they have a giant pile of cash. What else? Talked about Dine Brands. Tronox is another one of my free rare earth positions. This is behaving really well intraday, bouncing off the 50-day moving average. This is probably going to be a bottom here. If the Iran situation is, again, ships are moving through the Strait of Hormuz, and back to Iran a little bit, I wouldn't be surprised if 1 or 2 ships get sunk in the next week. I would be surprised if it was a lot of ships getting sunk, but ships are turning off their transponders and they're navigating the Strait of Hormuz. Most of the Iranian Navy's been destroyed, but they had a lot of mini subs. They've got, I think, 20 or 30 mini subs, and it hasn't been announced how many of those are still active. But Iran does not have radar towers at the moment. So radar sends out radar, so then the other person knows where all your radar towers are, and they all got bombed. So Iran doesn't have a way of tracking moving ships. You've seen recently the missiles that Iran has launched. They've been launching them at residential buildings, desalinization plants. So Iran is getting satellite footage from Russia and China on what to target, but it's not live tracking to target ships. So they've been bombing residential buildings in Emirates, but they haven't been bought, and desalination plants in Bahrain, but they haven't been able to hit ships because of the radar towers. So I think the Iran situation's over, and all these dips are buyable dips because we're going to be back to the races. Somebody's asking about love. So Lovesac sold off hard. This is way below the 200-day, way below the 50-day. It's amazing how the Iran war is going to affect people buying sofas in the United States. I think this is dramatically overdone. I think this is a huge buying opportunity. When it comes to the consumer, I want to focus on the interest rate sensitive stuff the most. And even though their couches aren't as interest rate sensitive, it's going to be tied to people moving houses. So the housing market unfreezing. So mortgage origination, interest rate, consumer discretionary. Now this is an ugly chart. So there's no resistance lines here, except for maybe, well, if you're going to call a bottom, you could call that, maybe call it a double bottom, except it's a little bit below there. So it's kind of broken down. I don't mind catching falling knives, but this thing is really, it's making new lows. Now it's also oversold on the RSI. So I think so the MACD is not turning up. So that's not indicating a bottom, but the RSI is at oversold. So that could easily be the inflection point here. So, I mean, I think over time, this is not, Lovesac is not a heavily indebted company. I think they're even GAAP net income profitable. Let me double check that. Yeah, they're GAAP net income profitable. Their debt is very moderate for their size of the business. They're growing. They're just an interest rate sensitive consumer discretionary, unless you think that their fashion is somehow a problem. And I don't think it is. And plus, over the next 2 years, they're expanding to like outdoor patio furniture. I think Lovesac and Crocs are very similar in that they have, they don't have broad appeal. They have super users, but those super users then buy more stuff direct to consumer. And direct to consumer, the profit margins are much fatter. So I really like Lovesac. There's only one thing I don't like about the company, and that's the founder CEO who keeps selling all of his shares. But that's not enough to turn me away from here. I really like Lovesac. I mean, a company that has way less torque. The torque here is incredible, right? Price to sales of 0.24, and this will probably get back to a price to sales of 1.5. So you're talking about a 6x here probably, plus increasing revenues. If you want something that's kind of just an easy no-brainer, buying legacy housing below book value. They do share buybacks whenever it's below book value. So that's going to be the floor. And they also are they're a data center beneficiary because they're going to make workforce housing for the data center build out, which is going to be focused in Texas, and their manufacturing is focused in Texas. So legacy housing is sort of a interest rate sensitive, sort of a no-brainer one. And then Portillo's, the chart looks bad. I did buy 100 shares of Portillo's today. It has, that's a nice hammer candle today, though. This could be a short-term bottom. I mean, I think if we get news that more ships are passing through the Strait of Hormuz and that the Iranians are not able to do much to them, I think things are off to the races. But I bought some Portillo's today. This is not a good-looking chart. The RSI could have more to fall to oversold. The MACD is not really turning up much, and you're below the 200 and the 50. So, and the only thing positive there is the hammer candle. I bought some Portillo's today. It is an ugly chart. Orion Engineered Carbons. Yeah, this chart went from looking really good to really ugly fast, but a big chunk of that was the Iran war. They have a lot of European manufacturing. I think this is a cheap place to buy. When it comes to Orion Engineered Carbons, if I'm smart enough and if it works this way, so sometimes everything re-rates together. With Orion Engineered Carbons, there might be a chance to rotate money. So to make money off of trucking, wow, look at that. I mean, the this is a huge buy today for Heartland Express. Oh my gosh. This has no business selling off this hard. I mean, I guess you look at the price of diesel. I don't know how well hedged their diesel prices are, but there's a huge trucking boom right now going on in the country. But if I'm smart enough, I'll be able to take profits from Heartland Express, roll them into something like Goodyear Tire, which is, wow, that is super cheap today also. That is extremely oversold. And then take the money from Goodyear Tire and rotate it into Orion Engineered Carbons. Now, sometimes everything reprices together and you don't get a chance to rotate. But just as an experiment, so trucking consumes a lot of tires. Trucking is having a rebound. And then seeing the time lag before the earnings start improving. So from the trucking company to the tire company to the carbon black company, because you're going to have a restock. So the trucking companies have to start buying tires, and then the tire companies start restocking their inventory and they buy more carbon black. So I think there might be a 2-year process, like a 2-year, sometimes the market prices all this in at the same time. But if we're smart and clever and lucky, we might be able to just rotate money from a huge rally on trucking, take the profits from that, pivot that into the tire company, and then take the profits from the tire company and pivot into carbon black. If it worked out that cleanly and smoothly, then we could all pat ourselves on the back for being a bunch of geniuses, or they all could move together. But Goodyear Tire is very interesting here at that price also. And then, but yeah, OEC, that story might be further out. So I did that on the recent earnings call. OEC said the carbon black market was still tight, but Tronox said that the titanium dioxide market was booming, increased prices and increased volumes. So in the short term, take all of your OEC discretionary buying income and probably in the short term buy Tronox holdings. And I do think Orion Engineered Carbons is going to be a slower story, but it's, I mean, if you wait 2 years for a 4-bagger, this is going to go back to $20 again. It's likely to go back to $20 again someday. So how many years do you have to wait for a 4-bagger for that to be a good idea? And yeah, I mean, you could wait 3 years for a 4-bagger and you still dramatically outperform the market. But yeah, Orion Engineered Carbons might be a slow story. And then interested to hear your thoughts on LifeMD. Yeah, LifeMD is very interesting because the FDA targeted 30 telehealth companies that were selling compounders. And LifeMD, they only ever did the brand partnership. They only ever did things the right way. And now 30 of their competitors have been targeted with FDA letters to stop selling compounders, including the big one, which was Hims. But just today, Hims announced that they did partnership with, I don't know if it was Eli Lilly or Novo Nordisk. So Hims is going to be selling the branded stuff. It wasn't clear if Hims was going to be cut off from branded GLP-1s. There was a massive rebound. It's up 40% today. So just this morning, Hims announced that they were going to sell branded GLP-1s. The stock was down, again, on these FDA action against these compounders. And then how does LifeMD fit into this? So telehealth platforms for GLP-1s are not a winner-take-all market. They're a customer acquisition cost market. So for example, in Uber, the drivers want the platform with the most riders so they can make more money. And the riders want the platform with the most drivers. They have less wait time. So there's a winner-take-all self-reinforcing feedback loop within Uber. And that winner-take-all self-reinforcing feedback loop also is in housing for Opendoor. But where you buy your Ozempic from does not have a self-reinforcing feedback loop. It's a market that can have competition. It can be a fragmented market. So just because Hims is in the market does not mean that LifeMD is not a very reasonable market participant. And LifeMD has the partnership with Medifast. So LifeMD has 20,000 gig economy workers, 20,000 yoga instructors and fitness trainers who are going to be trying to sell people on, buying their coaching services and also getting their Ozempic prescription through their coaching services. So they've got 20,000 free salespeople And again, this is not a winner-take-all tech platform. This is a customer acquisition cost market. And in a customer acquisition cost market, LifeMD is going to have zero customer acquisition cost because they have 20,000 MetaFast partnership people trying to get people onto their platform. So I really like LifeMD. Odds are really good that you start seeing enrollment growth, and they'll be back at $15 a share in no time. So yeah, I think this should be even a relatively fast five-bagger. You just have to start seeing results of growth on the platform. And I think they'll do it. I think they'll solve those problems. I think they'll make it all work out. So I do really like LifeMD here. I have no way of predicting how fast their platform is going to grow. But now that you have oral GLP-1s, so that's going to double the size of the market. What I learned from the nasal spray epinephrine people is just how much some people are afraid of needles. And so having the GLP-1 pills is going to double the size of the market. And then having the cost go from $1,000 a month to $150 a month is going to dramatically increase the size of the market. A year ago, it used to be the story that it was about when will health insurance cover GLP-1s? And, can they see on the platform if health insurance will cover it? And the story really changed to, in order to compete with the illegal compounders, Eli Lilly and Novo Nordisk just lowered their prices. And so why buy the bootleg knockoff when you can have the name brand for $150 a month? And I think that's going to unlock this whole market. I think it's going to blow the door off the hinges. Any thoughts on ProFrac Holdings? Yeah. So I talked about this early in the live stream, but if I look at oil services, what's interesting is oil services were down on the Iran war, although ProFrac Holdings, ACDC, I think, was actually up significantly. So they were just extremely oversold. Part of this is the natural gas story as well. So ProFrac Holdings has that Haynesville exposure for natural gas. I think natural gas was up significantly. And if you look at, what was the oil IEO? So again, oil was up 30%. Oh, wow. Holy crap. Just right now, crude oil is getting back down to $85 a gallon. That's amazing. It was 95 a minute ago. That's fantastic. There must be some news announcement about transit through the Strait of Hormuz going easier now. And also, wow, we're hitting 5 minutes to the close in the market. So again, I believe the market anticipated that the Iran war might still go on for a couple of months, but Iran's ability to destroy ships in the Strait of Hormuz is a short-term thing. And I think the oil market correctly anticipated that. So yeah, we've had this nice bump up in some oil companies, but odds are still pretty decent that oil prices don't stay high in a sustained way until mining for base metals really stays high. And mining for base metals, and like if you look at steel and things like that, it's just been dead. So if I look at the metals, I'd want to look at steel and aluminum. Aluminum might be up, but yeah, so steel prices are doing nothing. I think we have to be further into this rate cutting cycle and further into the, let me go back down to this. So we've only had 1 month of ISM manufacturing above 50. I think it's going to take a couple of years maybe for ISM manufacturing, for us to be in a manufacturing expansion before the energy consuming industries really are in the peak part of the cycle, before oil stays high. So I'm not super bullish the price of oil right now. Let's see. I thought of panic buying LyondellBasell and Cleveland or CF. With CF, it's a chemical company. Thankfully bailed out. Yeah, I don't think punting into fertilizer companies is smart right now. I think some of those will give a lot back. What miners am I looking to buy? Jay is asking what miners I'm looking to buy. I like Magna Mining. What do I think rebounds the most if Hormuz opens up again? So anybody who uses sulfur in refining, probably Sibanye-Stillwater. I like both Sibanye-Stillwater for a short-term bounce, and I like Magna Mining for just a long-term accumulate. So my two miners are probably Magna Mining and Sibanye Stillwater right now. Well, this is well over an hour, and thank you guys for coming. If this stream is good quality, then upgrading to StreamYard was probably a good idea. And I will be posting this video on Substack for paywalled subscribers. Anyway, thank you guys for coming, and sorry about the weekend failure for what am I buying this week for the audio being broken. I hope you guys have a great week.